Ken Polcari joins us, Kathryn Rooney Vera, and Emily Roland. Emily, I ended with you. I want to get your take on that this push now for clean energy or to address the climate leaves out the dirty little fact that in the interim, it might be about jobs, but more jobs are being lost now than gained. How far does this go? Do you worry about that?
Yeah, Neil. So government intervention in the economy, in this case via job growth, can often result in an inefficient use of capital. And if you recall, during the Obama administration, there were $500 million of taxpayer money that was used to fund solar panel company Solyndra, which then promptly went bankrupt and all of those jobs were lost. So, hate to get too sort of nerdy with economic theory here, but it all comes back down to the invisible hand, which is the driving theory behind capitalism that suggests that companies or individuals who act in their own best interests and compete naturally, that's always going to result in a better outcome than governments that are highly regulated or centralized. So as you mentioned, we all are in favor of clean energy. There have been a lot of great initiatives, whether it's wind or solar, but companies need to act and compete naturally in order for job growth to be sustainable.
Well, the one thing that worries me, Kenny, looking at all of this is that we lose sight of the forest for the trees here. And I'm all in on all types of energy. I don't like to pick and choose one over the other. But I'm also, pretty pragmatic about this. The immediate fire for the time being seems to be rocketing energy prices, particularly natural gas prices, up better than 50%. Let's address the fire. We have always cognizant of some of the energy issues we're going to have in the future. But I think you can get all in. You don't have to do one at the expense of the other. Your thoughts?
No, I agree with you. And I think that's becoming very clear to people, right? You can't just transition and say, OK, we're going to stop using fossil fuel. We're going to try to put that industry out of business while we transition. You need to be using both, because the only way you're going to create the energy to charge all these electric vehicles, to charge all the electric that we want to use at the moment is with fossil fuels. You can't show me where solar power and wind power is charging the world. It's just not happening at the moment, which doesn't mean I don't support it. It just means let's be realistic on how we get there.
Now, the president, the backdrop for his remarks this week, Kathryn, was a former coal facility. I guess it looks like it had been demolished because the backdrop there wasn't the most eye-appealing. But having said that, it's going to transition to this wind center. All well, all good. Years off, though. And right now, we're in the middle of this real energy spike, particularly in the natural gas arena, which is why people are looking at their utility statements right now and saying, what the? But this is a family show. You can't complete that statement. So what do you make of where we're going here, Kathryn?
Well, yeah, and look at Keystone Pipeline. Too bad we shut that down on day one. 1,500 jobs were lost there, and a lot of those jobs at that time, Energy Secretary nominee Buttigieg said that they would be replaced, and we haven't seen really that come to fruition. So the majority of the U.S. power grid is still, as you said, 20% coal, 40% natural gas, 20%, less than 20% come from renewables. So the facts are there, and we need to continue to use what we have. So the BLS, I was just looking at some data, more than 500,000 auto service technicians were employed in May of 2021. So in this transition from greenhouse gases to green energy, a lot of the jobs that are lost are going to be these mechanics, service techs, blue collar jobs, because the fact is that the internal combustion motors, the conventional motors, are more complex than battery electric vehicles. So it's doubtful to me that we're going to get a one-to-one replacement, right, even in the best case scenarios, let alone these millions of jobs that the Biden administration seems to think and seems frustrated with in their progress in getting in the green energy space.
Yeah, I guess this sounds passé on my part today. What do I know? But I always believe let the market decide. The government can't force our habits here. They obviously can direct a lot of money, but sometimes it doesn't work out the way they envision. So I guess we're back to this issue of how much can or even should the government do, particularly given the current crises we have right now. What do you think?
The government should stay completely out of it, and the more the government gets involved, unintended consequences come to fruition. So
Emily, what do you think? I'm sorry, there. Okay. Emily, what do you think of that argument?
Yeah, sure. I agree with Kathryn. Again, this gets down to free market competition, back down to capitalism, and it should be at work here. Look, there's been a lot of successful companies that are working on these green energy initiatives. As we've highlighted on the panel today, it's going to take a long time to get there. I think the attention should potentially be paid here to the energy crisis that is at hand. Clearly still a concern. We have seen oil prices come back down. We're at about $95 a barrel on WTI. We do believe that the commodity complex is cooling. That has key implications across markets.
Well, that could be a demand thing, right? That could be a demand thing, Kenny, that the world is already speaking out loud here that they're cutting back. Already the European Union is urging member states and their citizens to curtail natural gas consumption up to 15% to prepare for a cutoff in supply. So when countries like that, and I think even in the case of Germany, right now revisiting coal to get us through this, I mean, they're being pragmatic about it. They haven't given up their climate dreams and hopes, but they're aware of what we're dealing with for the immediate time being.
Yeah, that's right. And that really gets back to where we are in the economic cycle, in our view, Neil.
Got it. Kenny, to that point.
Yeah, no, and I think you're exactly right. Whether or not Europeans are cutting back because of the Russian crisis and they're just trying to stay ahead of it, that's another issue that's affecting them. But if you look at what's happened in natural gas and coal stocks over the last 6 months, they've all accelerated. They've all moved higher in anticipation of still this demand to create energy around the world.
Guys, if I can step back and look at the markets this week while I have you fine brains with me, I am curious what you make, Kathryn, of what the market was telling us this week. The sell-off yesterday notwithstanding, it's a good week for the markets. A lot of the markets have come back appreciably. The NASDAQ, which had been down in excess of 40%, now down 24% year to date. S&P, which is deep into a bear market, now down 17% this year. The Dow down a little bit more than 12%. It, too, was in a bear market. I'm not saying or heralding these was a great, but we're well off our lows. Technology stocks, I guess, will be tested a lot next week. But, Emily, on that front, where do you see things going from here?
Yeah, we've seen a bit of a bounce. In fact, a 9% bounce in the S&P 500 since that bottom back in early June. And over the last week or so, there have been some key developments. One is that earnings have come in less bad than feared. They've been okay. We're looking at about 5%
I like the way you turned that, less bad than feared. That was. I
don't want to get too excited about this earnings season because I think the 10% that analysts have penciled in for 2022 is likely far too optimistic. We've seen some relief on the commodity front. We've seen some relief as far as a weaker dollar. We all know that a stronger dollar could be a challenge to corporate earnings. So investors are feeling a bit of a sense of, the Fed is probably going to raise rates by 75 basis points next week. 100 was feared at one point after that 9% headline CPI reading came in. So a few moving parts here kind of creating a bit of a bounce. We would be careful to chase it here, that we do think that there's more volatility to come. Well
put. Kathryn, that strong dollar to which she alluded to, the stronger the dollar is when for U.S. multinationals, once their foreign achievements are translated back into dollars, there are fewer dollars they get back for that. So that could be a problem. So the flip side of a world rushing to the dollar as a safe haven means these companies could really be under pressure, right?
I expect them to be continually under pressure, Neil. I think the second half is going to provide opportunities for investors to take advantage of bear market rallies. My suspicion is that the labor market is already rolling over. And the real recession is not what the 1Q, first quarter, second quarter of this year are turning negative. My bigger concern is when the labor market does roll over, which it is, and we get a recession in 2023. The Fed's already hiking. The Fed has to really retrace a lot of this expansionary policy that's done, and I think we're in for a rocky.
I hope you're wrong on that. You've been very good on all this stuff. We'll see what happens, guys. Again, the Federal Reserve does meet at the end of next week. We're expecting to see a 3/4 point rate hike. We'll have more.